Hello and welcome back to another week of your Mortgage Market Movers Weekly, where we are detailing everything that's going on in the macroeconomy to help you make better home buying decisions. This week's 30-year fix is sitting at a 6.27, which is down from last week's 6.3. Looks like rates are really starting to come down finally. We kind of hit a little rate floor recently, but rates have fallen below that, so hopefully we see more downside, and this week we finally get some data that is going to clue us into what the Fed is planning. Regardless, shutdown or no shutdown, we are finally getting data this week, and we are going to discuss what that is as soon as we get into the chart. So let's get on over there. So, like I said, the rates are finally starting to come down below this rate floor that we had. So we are looking at the U.S. 10-year, which is, of course, what rates are based off of. And when we see, so right now, the 10-year is sitting at a 3.986. Really, there was this 4% floor. It was real tough to get underneath. We almost did back in mid-September, but then the 10-year popped back up. Let's see. Last time it was back below here was in April. So prior to that, the rates really, let's see. So this was going to be September of 2024 is around when rates were coming down here. Now, there's definitely a possibility that the rates continue to dwindle down. I personally don't think that's a very likely possibility, but we'll see. The market can do whatever the market does, and just because someone expects it to do something does not mean it will. Now, as you can see, people have been buying into the bond market, which makes the yield go down. So as long as investors are flooding into the bond market, we will see the U.S. 10-year continue to come down. And the reason that I am a little suspicious of that is because if we go on over to the U.S. stock market, which we can use the SPY as a proxy, SPY, this is all-time highs, 673.95. This is the highest it has, that's the highest it's literally ever been, and we were right there, and there typically is an inverse correlation with the bond market and the bond market and the stock market, though that doesn't have to be the case, right? So it's totally possible that people buy into both or both fall at the same time. Now, the reason that a much lower U.S. 10-year doesn't make too much sense to me is it's just that if people are getting great returns in the stock market, the returns are usually much higher than you can get with a bond, right? So, and you're locking your money away with bonds. So typically, when the U.S. stock market is doing really well, we don't see bonds doing as well. So with prices at all-time highs, unless these prices come down on the U.S. stock market, I don't know if we're really going to see the bond market continue to rally. It just doesn't make sense from an investor's point of view. What would make sense is if there's a lot of uncertainty in the market, which that's exactly what there is. So, we usually don't do this, but let's just take a look at a few different assets right now. So people are buying into bonds. They're also buying into the stock market like we just saw. This is a really interesting one. So gold is, of course, typically a safe haven asset, and it has just been ripping and roaring up. It's crazy how high gold is. This is the highest it's literally ever been. And, it just kind of begs the question of, so investors are buying into the stock market, they're buying into the bond market, they're buying into the gold market. So why would you buy into gold? Why would you buy into bonds if you could buy into the stock market where you're getting far greater returns? It just doesn't make sense. Gold is typically a safe haven asset, so is the bond market. So what this points out is that there's just a lot of uncertainty in the market right now. I think if the the stock market, the SPY, if that continues upwards to new all-time highs, I think we can potentially see a pullback in the bond market, which will lower the U.S. 10-year, raise it, and raise interest rates too. Now, one thing to look at is the likelihood of the Feds cutting rates more. And, as we know, when the Fed cuts rates, it typically is pretty solid for mortgage interest rates. These aren't directly intertwined, but they do have some, relationship. So this was a 100% chance of a rate cut. Now it's a 99.4. Are they going to pause for the October 29th meeting? More than likely not. It's pretty baked into the price right now of all the different markets, right? The bond market, the U.S. 10-year, the stock market, that the Feds are going to do at least one rate cut. And it looks like no one is expecting any jumbo cuts. And then we're expecting another rate cut before the end of the year, 98.6% of another rate cut. So I think the uncertainty comes not from the Fed rates, from any rate cuts. I think it comes with government shutdown. I don't think investors know what's going on right there with that situation. I don't think that investors know what's going on with the tariff situation. Of course, we had Donald Trump said that there's going to be an additional 100% rate of tariffs on China. This was walked back a little bit as a misunderstanding. It was regarding export controls on I want to say it was critical minerals from China. China clarified. Donald Trump said that tariffs are still on the table. However, he knows that more than likely a deal will be made. So those were walked back. And then more recently, what day was it? I want to say it was Friday morning. Yeah, it was Friday morning. Those were walked back even more. And Donald Trump said that tariffs of that level were unsustainable. So it looks like a lot of the tariff rhetoric is being walked back. This is what allowed for the U.S. stock market to rally almost to new all-time highs. But there's still a lot of uncertainty that's going on in the market, right? So, we don't have any data, and this gets us to the next point. We finally have data coming out, and this is Friday, October 24th. We are getting CPI, which is this isn't the most optimal way that the Feds like to look at inflation data, but it is inflation data. So this is the consumer price index, and this is really, so they take a basket of goods and then they look at the increase of that over a time span, monthly, and they look at inflation month over month and then year over year. So there's core and then non-core. Core is the removal of food and energy, as those are volatile goods. So we are finally going to see some inflation data, and that is really Jerome Powell said that they have regional data to go based off of for rate cuts, but this is going to be our first taste of, actual Bureau of Labor Statistics data to go based off of. So this is a forecast of a 0.3% increase for inflation. Now, we really don't want to see that get much higher. I think if inflation shows to be a persisting issue, then the 10-year is going to go back up because the bond market is going to drop. If this 2.9 from previous is much higher for year over year, that's really going to be bad for the U.S. 10-year. And there's a recent speech from Jerome Powell where he said he believed that tariff inflation was more transitory, right? So This seems to be a one-time price increase, but long-term should not be sticky for inflation. So we really just have to see. I want to say it was a few months ago. We had a pretty high CPI or PPI print. It was one of those. It was way higher than expected. So we have to see if the tariff price increases are going to stick. Did the Fed expect those to be long-term? If they're long-term, then that's really going to be bad for the bond market. Bond market does not want to see long-term inflation. I think that short-term inflation, they're fine. But, I mean, imagine you're an investor. If you're buying, a 10-year bond, 20-year bond, and inflation is just crazy, you're going to want to get a much higher return on that than something like 4%. If inflation's, like around 3% or so, you would get much more bang for your buck in a different market. So that is my take on that. Other than that, I mean, we have existing home sales, which this should come out, and that's going to be Thursday at 10 a.m. It looks like there's a forecast for home sales to be up, and I think that would make sense with rates coming down. I think that I would have to look and see what it looks like for applications, but I would imagine that with rates coming down, that demand is starting to come up a little bit more. That's just my intuition, though. I do not have the data to back that up as of now. Let's see. Did we cover everything from last week? I mean, there just wasn't really much to cover from last week. Really, the big thing was Powell speaking. And yeah, so we will keep an eye out for CPI on Friday. There's also a PMI that I guess this is not tentative, so this is actually gonna go on, and this is flash manufacturing. So this is the Purchasing Managers Index for manufacturing and services. Above a 50 means an expansion. Below a 50 means a contraction. So we need to see, is manufacturing still growing, or is manufacturing still booming? Is services still booming? Below 50, bad news for manufacturing. Below 50 for services, bad news for services. The next week, we can expect on the 29th is the decision for the Fed rate cut. Like I said, it's pretty priced in that it's going to happen. So the expectation is that there's going to be a cut. What really matters is the press conference. So Jerome Powell's press conference is something that you definitely want to be tuned into. If you care about the markets, you definitely want to be watching. It has such a huge impact on the market. It can really shoot those rates. The U.S. 10-year can really shoot it up or down, depending on what he says. So that's what we got for you this week. Like I said, the 30-year fix is sitting at a 6.27. Let me see real quick. I wanted to see if I'm sure that it's somewhere on this website about mortgage applications versus and looking at how many applications there are. But maybe I'll find that for next week. All right. Well, that's all we had. So yeah, if anyone has any questions about any loans, the rates really are coming down. So if you are thinking about refinancing, please don't wait. It's so silly to wait and just hope that the rates are going to get back to like 3%, 2%. If you could just refinance right now and save hundreds of dollars, if you could save like $200, $300, $400, skip a couple of mortgage payments, I mean, you're throwing away money by not doing that. So in my opinion, and I get it, I'm a loan officer, so I have an incentive to say this, but I mean, outside of that, no matter who you go to, of course, Mortgages by Linda is the best, lender to go to. But if you're going to go somewhere else, it just doesn't make sense to just hold off and just hope and hope and hope for lower rates. That's how you catch yourself in 2019 not buying a house when the rates were in the 2s, and now it is 2025 and the rates are in the high 5s and low 6s. It doesn't make sense. All right, well, give us a call at 877-TEAM-MBL or visit us at www.mortgagesbylinda.com. Have a great week, everybody.